I really do think we're at a different moment in time. Not the fundamentals of insurance, but I think the nuance within those fundamentals. You still have to handle claims properly. You still have to underwrite. You still need data. You still need to price properly. What is changing are really two factors: the rate of speed in which you have to adjust and what consumers' expectations and behaviors are.
That's Rick McCathron, President and CEO of Hippo Insurance, from his interview with me live at InsurTech Insights USA 2024. And this is the future of insurance.
Thank you so much for being here for this conversation. Rick, great to sit down with you. We've done a couple of these before, and every time the story evolves, it's a fast-paced world of Hippo. Could you give everyone just a little quick intro on yourself and on Hippo, and then we'll dive in?
Yeah, no, glad to. And thanks everybody for being here. My name is Rick McCathron. I'm the CEO of Hippo. Hippo is an InsurTech company that went public almost 3 years ago, 2.5 years ago. We're about 8 years old in total duration. My background is 31 years of insurance. So I've spent time on the carrier side, the agency side, the tech side, the aggregator side, reinsurance, all the different aspects of insurance. So I got to tell you, the last 8 years at Hippo have been a wild ride, and we're feeling good about our progress.
Well, that's awesome. And we first did a fireside during COVID lockdowns. You were newer to Hippo, and it's pretty amazing. I don't think you guys had a carrier yet. Like, it's been a lot of evolution and change. So yeah, I can only imagine probably the speeding up, not slowing down across those 8 years. But I'm very excited to sit down with you today. I do want to talk about things that I hope are not too triggering for you, but starting with 2023, which I think for a lot of folks who are property exposed, homeowners carrier, just saying the year 2023 is like, oh my God, the only thing that could be worse is saying hail, but I'm going to say that too. It is a year where anyone writing mainline coverages, not just homeowners, felt it was really tough for a number of reasons. I keep talking about how I think it was different than tough years in the past. I think there's some macro factors, whether it's climate, supply chain, a number of things. I'm curious if that's your take, and oddly, like, that's absent a named storm or major named storm in the year. Is like we're hitting reinsurance for cat exposure without what we would have thought was a cat exposure. How did you respond to all that?
Yeah, look, it was tough. I definitely have a bit of PTSD when I think about the second quarter of 2023. In my career, it was probably the most difficult quarter I've seen in the industry. This reminds me a little bit of the Northridge earthquake. And when we sort of think about what has happened, the evolution post-Northridge earthquake, what made 2023 more difficult, especially for earlier stage companies that are pretty significant purchasers of reinsurance, there had been a shift within reinsurance for the couple of years leading up to it. And not to bore you with a lot of detail, but there are two primary types of reinsurance. There's what's called quota share, and that's proportional participation and first dollar risk. And then there is cat exposed or excess of loss reinsurance. And so the trend had been shifting to buy net quota share, which means quota share with a cap for catastrophe, and then buying excess of loss insurance cover above that cap. What happened in 2023 is there weren't any huge events. There wasn't a big hurricane, a big winter storm, that type of thing. But there were a ton of very small events. And these small events all hit that net quota share cap, but they all fall below the excess of loss reinsurance. So you're finding companies like Hippo that we didn't have adequate coverage for those types of events, and it hit our balance sheet and our cash position relatively hard. Now, good news for us is we have lots of cash. We had lots of cash. We had enough to weather the storm. But for many folks, it was there was existential threats there, and so it forced a lot of changes within many companies.
A lot of the things that people did in 2023 were necessary. Raising rate, pulling out of some spots. You guys were not alone, pausing new business. That frontline newspaper, like insurance, got a lot of press last year. Unfortunately, it was not the kind we want, but it was a common thing. Those are super necessary stem the bleeding moves. What bothered me was not that we did those things when we had to, because we did, but then Q4 came around and the stock market rebounded and a number of carriers did so well on the investment side that I seem to hear like they forgot that Q1 to Q3 was fundamentally unprofitable and there were problems in the business because they stemmed the bleeding and then they got investments. And it's like, oh, everything's fine. It's not. What are you doing to think about not just being okay for right now and we stemmed the bleeding, we took rate, we paused new business and we're back on with some adjustments, we're doing better on the investment side, but like longer term, because it's not going to stop hailing. Sorry.
Yeah.
It's not going to stop doing a lot of things. Supply chain costs might not be escalating at the rate they had been, but they're not going to fall or not fall significantly enough. Morgan and their friends are not going to stop suing everyone. And I mean, like a lot of those macro factors are here to stay and new ones will emerge. How are you thinking about that shift for the longer term viability?
Yeah, I do think there is a fundamental shift happening in insurance holistically, not just related to the financial results of insurance organizations, but also related to the consumer buying habits and the way people think about insurance. So I do think we're at an inflection point. I think there's a critical thing to remember about insurance is the one product that you manufacture, but you don't know what the cost to manufacture is until years down the road. And if you get it wrong, you have the potential to get it wrong in a big way. And then once you recognize that you've done something wrong, whether it was because of a mistake within a company or because macro trends have changed, inflation, labor, material, all of those things. And we did hit a bit of a perfect storm in that in 2023. It takes time to actually get the adjustments that you need from a regulatory perspective. So most states require you to file any of these changes that you want to do. So what companies tend to do, and I don't think it's the best solution, but I think it's a necessary solution to your point, Bryan, is that pendulum swings very aggressively one way or the other. Yeah. And what I think is a trend that is changing is trying to stay with technology ahead of that curve. The ability through AI, through data analytics, trying to be quicker in your reaction to things that are changing. And that's one advantage that I think InsurTech companies have. At Hippo, if you look over the last couple of years, we've done 200 rate filings and implemented 200 rate filings. If you look at a traditional tech stack for an insurance company, very difficult to do that type of implementation. Yeah. So I think that's one piece of it. The second piece is you've got to diversify. And I don't just mean diversify geographically. You've got to diversify in your business operations. So what most folks don't understand about Hippo is the Hippo Home Insurance Program is a relatively small portion of all the different things we do at Hippo. Hippo has a fronting carrier, and we support almost 20 different MGAs on that fronting carrier to give them A-rated, A- rated paper. So they can be in business, and that's Spinnaker Insurance Company. We also have an aggregator called First Connect that builds technology for the benefit of independent agents, giving them tools on market finding, giving them market access, giving them other technology, sort of consumer-grade technology for the agents. We also have an agency of our own. So we sell a lot of other people's products. We only manufacture homeowners insurance, but we sell auto and we sell flood and we sell life and different things that the customer might need. And finally, our smart home offering. And our smart home offering is those proactive preventative things that help customers avoid the claims from happening in the first place. So the diversification that creates sort of ballast when you have these up and down years, these good and bad years, is something that has really helped us, which is why we've been able to improve the loss performance so significantly while still growing the total portfolio and the total book of business, because we have these other aspects that are non-risk-based that we're growing.
Well, so that's something I want to hit on. So we talked about shutting off for new business. Lots of carriers did that. You guys have recently turned new business back on. What does the term growth mean in this context where you're growing the way that people might have been growing before and the kind of drop your rate and compete and buy share kind of dynamics that the industry's always gone through until it gets hammered and pulls back and it goes out again? What does the term growth mean to you going forward?
Yeah, I'll tell you what it means to me and what it should mean to all early stage companies. I'm not sure that it always does.
Yeah.
But what it really should mean is, can you grow profitably? It's really important to not try to be all things to all people. And that was one of the things when we started Hippo. It was, can we cast a wide net? Can we try to bring homeowners insurance to the mass market in an easy way to purchase the policy? The problem is that by doing that, we forgot that there are different segments, different people, different profitability thresholds, different demographics, different psychographics, all of these components that make it very difficult to be profitable in all of these simultaneously. So what we've really done on the Hippo home insurance product is double down on two primary areas. The first area is our Generation Better customers. Customers that truly want a partner to help them protect their home. And these are the customers that are embracive of IoT devices, willing to give us additional data, want to participate in Hippo Home Care, and try to figure out, how do I make this house more resistive to loss? And they want to do it because they want their house to stay nice. So that's one area that we continue to focus on. The second is through strategic partnerships with things like home builders. And making sure that we have built the technology to quote a house that hasn't even been built yet, and partner with home builders to make sure that when those homes close, there's actually an insurance policy in place so they can close the house, because that's of course required. And in certain states, a state like California, it's not an obvious thing to say that I've got a new home and I can get homeowners insurance, especially a new home that is not yet eligible for Fair Plan because the new home doesn't exist yet, right? And there's a lot of technology that has to enable you to quote those homes. So really focusing on more of that embedded insurance with strategic partners, narrowing the focus on things that we know and have strong confidence will be profitable. These are still massive audiences. If you look at new homes, there's 1.5 million new homes built each year. It's still a massive opportunity, but let's narrow into opportunities that we have strong belief will be profitable.
You know, you mentioned before, insurance is the one product where we don't know the cost of product when we're setting the price for it. Something occurred to me recently, and I think the dynamics of the rate people have been taking and pulling out of the market and all that sort of made it a lot clearer, is not only do we not know the cost of product, but the price we set is intrinsically tied to the cost of product, because it's going to define who will and won't select us, adverse selection, et cetera. So we think we're doing something with rate for what we presume the cost to be, but in effect, we're actually changing what that cost is as we're setting the price. And so it's this like vicious cycle that whatever your predictions are, you almost can never get ahead of, making it that much harder. So just to make everyone even more unsettled about how tough it is.
Yeah, that's 100% right, Brian. And there's one other aspect that also makes it difficult, is if you're thinking about the reinsurance cycle and the pricing cycle for primary carriers or MGAs is not aligned. And so you have a situation where reinsurers will be losing money, and then the reinsurers change the price that they charge the primary carriers or the MGAs in order to provide reinsurance to them. Well, then the primary carriers and the MGAs actually have to file that increased cost into their rate filings, and it requires regulatory approval. Reinsurers don't require regulatory approval. If I'm a reinsurer and I want to change my price from 10% to 30%, they can do that at the treaty, which is once a year. If I want to take the delta of 20% and bake it into my pricing, I have to file that. And it could take, in some states, 2-3 months, in other states, 2 years. So you're always misaligned in the timing of profitability. So when I generally notice sort of hard market going to soft, and in my 31 years, I think I've seen 5 cycles, the trend that I see that tells me that we're moving more into a softer market is when reinsurance companies start actually making money, because that means that they'll reduce their costs because they want to get good product and put their risk capital against good product. So I do see that stabilizing, although weather is somewhat unpredictable and has the opportunity to throw a wrench into that equation.
Rick, I want to hit on one other thing that you mentioned that you and I have touched on in the past, and so I'm curious if it's still how you think about it. When you talk about Hippo Home Care and getting the IoT in there, it's hard to get IoT that actually stops loss, doesn't just signal to you that, hey, your house is flooding and you're out of state, so congratulations, now you can just ruin your vacation, but we can turn off the water and save your house. It's hard to get that into existing homes. There's insulation, there's scheduling. It's brilliant to get that in at the point of construction when everything's open and you've got all the trades on site anyway. So your relationship with those builders is really, it's brilliant when you combine it with the idea of putting the IoT in. But then the flip side is if you get the whole development and your IoTs and everything, that means you're also exposed to whatever weather patterns hit the entire development. And I think early InsurTech view was like, hey, you just sold 1,000 homes. That's brilliant. Putting a traditional insurance lens on that is that's way too much aggregation. And you guys have adjusted and said, how do we balance out this wonderful access to IoT kitted out, predict and prevent kind of homes with that's not a footprint that's viable from an underwriting standpoint. You mentioned the other sources of revenue for the business. You've used those other sources to affect, like, how do we address that market without necessarily hitting our bottom line? Is that part of when you think about growth, like accessing geography, but doing it in a smarter way?
Yeah, I think it's a really good question, Brian. There's a unique nuance here that I think Hippo has an advantage on. So you're 100% right. One of the challenges when you do new homes is that they're in a community. So by definition, you have aggregation and concentration. Now, we also know that the loss ratio minus weather, so the attritional losses or the non-weather loss ratio for new homes is significantly better. Yet you have concentration, and I've yet to find an IoT device that stops hail, as an example. So it's really important to try to figure out, how do I write as much of this business and to get the benefits of the new home, but also recognize that I don't want to have concentration and aggregation. And this is where I think we have the advantage, is in our agency, we can place that new home customer either with Hippo or with one of our other partner carriers. We have close to 10 partner carriers that also like new construction. And the perfect solution is, let's make a checkerboard and let's all take, if there's 10, let's all take 10% of a given community. And it creates that inherent diversification within that. Yeah. And of course, us as the agency in this, we still monetize the transaction through commission as an agency. It is far more important for us to make sure that we are taking care of the customer and protecting the balance sheet of all of our partner carriers, including us, as opposed to say, we have to sell a Hippo policy. No, we have to make sure the customer can enjoy their new home and have quality insurance, and that's what we're about.
Yeah, be part of that transaction and that relationship without it necessarily having to be on your paper.
Exactly right.
So it's not that you're old. You've just been around insurance for a very long time because you started early on in it. You're not one of these like accidental.
He's trying to say I don't look as old as I am, I think is what
we're too close in age for me to throw that out. But you have been around. You said 5 cycles. You've been in the ups and downs of the industry, and you've seen it from a different vantage points, like distribution, and then obviously now like within the heart of the balance sheet of it. I keep saying I think it's different. I keep saying, I think the dynamics are different, the macro factors are different. Given your experience, is that what you think? Like, do you think we're in a different moment? What does your history and your vantage point from that experience tell you about what's going on?
Yeah, I do. I really do think we're at a different moment in time. Not the fundamentals of insurance, but I think the nuance within those fundamentals. You still have to handle claims properly. You still have to underwrite. You still need data. You still need to price properly. All of those, I don't think, are changing. What is changing are really 2 factors: the rate of speed in which you have to adjust and what consumers' expectations and behaviors are. Those are the 2 things that I think are really changing quickly. So I was chatting earlier with a group of folks, and I used the example, when I started in the industry, if we wanted to send a note to an agent, we didn't have email. Email didn't exist. We actually used carbon paper, right? And if you look forward today, so you'd write, you'd have your come up copy and you'd have your diary copy and you'd mail, because fax machines were still more of a new thing.
And they still are. There's nothing wrong with fax machines.
Yeah. Yes, there is. There's a lot of things wrong with fax machines, but we'll let that one go. But you look at where we are today, it's totally different, right? I mean, there is a lot of technology. Yeah. That's taken 30-ish years for me to see. it's happening a lot quicker. You think about AI and the use of AI. AI is not one of these things that is in the future insurance companies or tech forward agencies will start doing. They're already doing it. 2 years from now, the AI that people are using today will be table stakes.
Yeah.
And so that rate of speed is really, really changing. And I think it's so important to recognize that InsurTech is real. It's happened. It's that genie is not going back in the bottle. The question is, how do you actually marry that technology with fundamentals of insurance pedigree and make sure that you're matching both of those things?
I want to push on something in particular that you didn't mention. Because I agree with what you're saying, except I think I don't like the fax machine, but I think there probably are some diehards within this industry. It's like us, lawyers, and doctors' offices, and that's it. No one else. There's no fax business without us. But on product, and I'm curious your take on whether you think the way we've defined coverage, which in all honesty, sort of dates back to like the 1960s. We've tweaked it, and there's some players who've done things that are a bit different, but more or less, the idea of what is the exposure and how are we putting together a set of coverages to deal with that is relatively speaking the same as it always has been. And we put different SIRs and deductibles and sublimits and whatnot to fine tune it, but it's sort of the same conception, which I would say is true for auto too. Cars, maybe today they still look similar, but nothing like they did when the original auto policies were put together. And 5 years from now, 10 years from now, nothing, even though it's roughly the same shape and it moves back and forth and turns, totally different. Homes are changing too. The exposures they're subject to are changing. Do you think we're either at or heading into a period where we need to stop and say, wait a second, this coverage is not fit for purpose. It's not tied to what the exposure actually is anymore. Or do you think we can make it work through the kind of tools that we've been talking about?
Yeah, I think emphatically it does not meet the needs of the customer today. And that was really, if you look at Hippo when we started, there were two things we were trying to solve for. One, better match customer need with the product. And originally we weren't going to have our own, we were basically going to distribute products through technology and through API. We weren't going to have our own product itself, our own insurance product. We were going to have a tech product, not an insurance product. And we went out, we realized none of these products are very good. They may have been great for our parents and grandparents, but they're not great for us. I mean, covering fur coats and pewter bowls, gold bullion, stock certificates, crimson mausoleums.
People generally have that in their homes.
Right. I'd like to have a list of policyholders that have gold bullion in their house, and we should have a conversation. But the reality is the product doesn't match what the customers need. So that was the first thing that we've tried to modify. The second thing is the personalization and customization. Actually, to your question specifically, Brian, I think there are two trends that are real and are happening. One is personalization and customization. I think we can thank Netflix for that, or we can thank Prime for that. You're watching something on Netflix and it says, oh, you liked Game of Thrones, which means you're going to like this. Customers are demanding that in all aspects of their life. We talked about before that things like, personal lines raters. That's not what customers want. Customers don't want you to give them a list of 5 options and choose one. The customer wants agents and brokers to say, this is the option for you that meets your specific needs. That customization and personalization does not yet exist, and it's starting to become a necessary component. The other piece, which we've talked about before too, is embedded insurance. You need to meet the customer where they are, and that is often not because they're thinking in their mind that I need homeowners insurance. It's they just adopted a pet. Embed the pet insurance within the adoption process. It's saying I just bought a house. Have insurance embedded in the purchase price of the house. I just bought a car. Have insurance embedded into the lease price of the car. It's that embedded nature that I think really, really makes a difference from easeability for the customers. And as an industry, I think we were making really good progress. And then we had 22 and 23 that made us all kind of pause and go, crap, like we need to make sure the fundamentals are there. I think it comes back. But the companies that are really successful is remembering the fundamentals, but remembering there's a customer at the end of this, and the customer has expectations, and we need to meet those expectations in a thorough way.
There's a number of carriers who, in their ad campaigns, talk about customized for you. The coverage is customized for you, and it's not. It's just here's a higher deductible, here's optional coverage. I mean, that is a type of customization, but that's not what you're saying. That's the same stuff we've always been doing.
Yeah, that's right. That's options within,
right.
Options within the standard policy. And I think it's a requirement that we do that. I think we're in a transition point. If you look at like hail, the exposure of hail, how are insurance companies resolving hail? Because the insurance companies have been taking it on the chin for hail for quite a long time. And why? Because if you look at the triangle of who's involved, there's the customer, there's the insurance company, and the contractor. Well, if you had a 1% deductible on a $500,000 replacement cost house and a hailstorm came in and you didn't have any real damage, it wasn't leaking, but a roofer came and said, for $5,000, I'm going to give you a brand new roof. And it's a $25,000 roof. How many customers are going to go, no, thanks, I'm good? Like most customers are going to say, cool, that works, that's awesome. Well, the problem is the roofer's happy, the customer's happy, the insurance company's screwed. So what insurance companies are doing is they're raising deductibles. That rebalances the triangle, but is that good for the customer? Not necessarily, because now your deductible's 5%. So now, because of inflation, it's not a $25,000 roof, it's a $35,000 roof. The customer pays $25,000, 5% of $500. The insurance company pays $10,000. The roofer is still making money. But what's happening is when the door knocker knocks and says, I can get you a new roof for $5,000, they're like, nah, my deductible's 3%. It's $15,000. The customers are going, do I really need a new roof or do I not need a new roof? Is it leaking or is it not? It's rebalancing that. Now, that's not perfect for the customer. A better solution for the customer is a hardened roof, a hail-resistive roof, maybe a different insurance policy, maybe a parametric insurance policy. It's a really cool company that's called Sola that's doing parametrics for wind and hail, like creating almost like a deductible buyback portion on a different balance sheet. It's creating unique solutions for this unique peril. And it's no different than, earthquake. When the Northridge earthquake happened, and I was in the industry when the Northridge earthquake happened and I lived about 5 miles from the epicenter, it was a standard coverage on most homeowners insurance policies. Earthquake's not a standard coverage. There are specialty companies doing a really good job with it. It's going to transition more into that, not just this temporary of raise price, raise deductible, be more diversified.
There's something else in the parametric, and there's I saw jump starters here as well. Like there's parametric quake offerings as well. One of the biggest problems is by the time the carrier, the indemnity carrier, knows about the loss and is involved, someone's probably already knocked on that door because they smelled money. And the public adjusters, contractors, whoever it is, they've already canvassed the area. And once they get one, then that neighbor is telling them, hey, I just got a new roof for $5,000. What a good deal. Or this guy's getting me it. If we did it through parametrics and we instantaneously or within a day, provided a form of coverage, we've headed off that aggressive sales tactic at the pass. It's not just about the economics are better and we're making them whole. We've also kind of short-circuited this commercial industry that is sort of cheating the system.
Yeah, it's 100% agree. It's also, we see this in hail losses generally. So when we started Hippo, we tried to be very proactive. We know when 2-inch hail goes over a neighborhood. We know this. We have the data that supports it, and we know 2-inch hail is likely going to have damage. And we would tell the industry that we actually proactively call the customer and say, hey, you had 2-inch hail go through. You likely have damage. We'd like to come to your house, take a look, do all that. I had a lot of people tell me, Rick, you're buying claims. And I said, we're not buying claims. Yeah. That claim was going to happen 6 months down the road or a year down the road. And the difference is I can get on top of it and ahead of it. And maybe it's a repair for $10,000 instead of a new roof. Everybody's happy. I'm mitigating the claim on my balance sheet by being proactive to the customer. Yeah. And I think it's finding that balance of proactivity so you can avoid the door knockers.
I think that's a strong point for us to leave on. Actually, Pete, your head of claims, brought that up yesterday in another session. We tend to look at a different approach to things with this notion of like, oh, you can't do that. You're buying claims. I hear it like texting when a tornado or a hurricane's coming. You're just buying claims. Well, you're going to end up with those claims anyway, or many of them. Only the ones you end up with will probably have someone else coming along for the party that's knocked on that door. So it's going to be a heck of a lot worse. So trading off what has become a severity problem out of what was a frequency line and bring it back to frequency, that's a much better problem to manage. Different balance sheet impact. So that's all about this mindset shift. I can't thank you enough for sharing really openly. It's been a tough year last year. You guys were no exception to that, but you've taken a number of changes. You said like 200 rate changes, filed and implemented. You've been moving very quickly to change the game. And I think that's what I would love everyone to take away is, the tourniquet stuff. We need to stop the bleeding, but we need to make some fundamental shifts and get on it. And we can't just wait until it's bad again because we made a bit of money all of a sudden. So I appreciate you setting that tone.
No, look, I think that's exactly right. And we feel very good. We've said publicly we'll be adjusted EBITDA profitable by end of year. We have high conviction that we'll achieve that. Now it's time for also to think about what's forward looking. How do we get back on the offense? How do we continue to build technology? How do we continue to improve product? It's time to get back on the offense. And I, for one, and the rest of my team are excited about that prospect.
Thank you so much, Rick. Round of applause for Rick McCathron, everyone. Thank you.